Hello, everybody. Warm welcome to the Fireside Chat here on the event of The Economist. I have with me Ernst, our Chief Head of Climate and Geoscientists. Welcome, Ernst. It's a pleasure to have you here with me.
Thank you, Christoph, and also a warm welcome to all of you who are attending currently this session.
So, what you as the audience might wonder why Munich Re is participating here at this event. That's the Climate Risk Europe Week of The Economist. Especially, you might wondering when it comes to the topic how the banking sector is responding to the climate-related risk management.
Well, let me briefly start with explaining and reflecting on the business model of a reinsurance company like Munich Re. Our business model is built on essentially three pillars: the understanding of risk, the measuring of risk, and ultimately the management of risk. And managing risk includes putting a price tag on these risks. And we do not only measure these risks and manage this risk based on current risk situations, we have a forward-looking on very long time scales. And that is the reason why our industry, by Munich Re, has started working on climate change already in the 1970s, as we have identified climate change as a risk of change. That also gives you a bit of a hint how we as an industry, how we as Munich Re work. Our DNA actually includes excellent knowledge and science-based knowledge, which means we need to cooperate and engage in scientific projects on climate change, in order to be in the forefront of scientific understanding and then implementing this into our business models. Having said this, in the past, the majority of our clients of the reinsurance industry were primary insurance companies, but also large corporates. And now coming to Christoph's point, why are the banks now and other financial services industries like pension funds and others are so much interested in the knowledge and expertise of our industry on climate change? And the main reason is that with the changes of their own clients, the need to better understand the science of climate change and what it means also to the business model of banks and asset managers, that has been the driver to approach our industry and access our knowledge also from new groups of customers, of stakeholders. And as I said, banks are in the forefront, and there are good reasons, and I guess we will address these reasons further in our talk today. And reasons are external drivers like regulators and others.
So how do you see, or what are, from your perspective, are the market drivers which really produce this high demand at the moment for services, but also for the desire to understand the impact of climate risk to the business?
Well, in order to answer this question, I have to go back in time a little bit, back to the Paris Agreement in 2015. In 2015, the heads of states, almost 200 heads of states, agreed to limit global warming to less than 2 degrees centigrade, with the ambition to stay actually at a maximum of a warming of 1.5 degrees centigrade. Now, this was a political decision. Next step was then science came into play. Science converted this temperature limit, this agreement, this contractual agreement, to what it actually means to achieve this limit, to stay within the 2-degree warming bracket. And the answer of science is that the world needs to go through a massive decarbonization, so reduction of carbon dioxide emissions and greenhouse gas emissions within a very short period of time. Now that means, however, that many industries, carbon-intense industries, have to adjust their business model over time. And that's called transition risk. So that's not only the mobility sector, it's the chemical industry, it's steel, and it's the electricity or power sector as well. because the business models need to be changed. Whatever has been fossil fuel-based today needs to be non-fossil and carbon-free in the future. The other element of the Paris Agreement is the realization that obviously also climate change leads to changes in the physical sphere of our world. And that's, to be a bit more concrete, that's exactly on what Munich Re and other risk management organizations are working on, the understanding and measuring of natural disaster-related risks. That's again part of our DNA. And natural disaster risks, which we already having currently, if you think about flooding or tropical cyclones or high wind speeds or so, they are going to change in terms of probability and intensity in the course of the next decades, driven by global warming. So that goes back to science. And now we have the physical risks on top of what I explained as being the transition risk. And identifying these risks, actually together with a third element, the so-called liability risks, regulator realized that climate change might potentially result in a systemic financial risk. And this is the main driver coming from regulators on banks and asset managers, but also, quite frankly, their own investors are asking more and more questions on reporting, for instance.
So I can I see that from this perspective, there are the three elements: transition risk, which might change the business models, which might change, let's say, on the one hand side, the demand for insurance, but also the demand for different type of investment or the evaluation of the investment. Then we have the physical risk, and I guess to this point we will come just in a minute. And then the third one, and that's also a very interesting one, that the change of liability or the perspective on different liabilities is changing dramatically. So when we are looking at the physical risk, as it's one of the core competences of Munich Re to assess the risk and transfer the risk. So where do you see the modeling approaches, how they are changing, what are the challenges, and what are the latest trends you wanted to share with us?
Well, our industry, and again also Munich Re, we started in the late 1980s with the development what we call CAT models, catastrophe loss models. And these models are essentially based on, again, scientific data, so historical data on tropical cyclones, on floodings, on hail, for instance. But they also have other elements like the vulnerability of buildings or communities. Then, of course, the values, the exposures of these communities play a role as well. Now, going back to the 1980s or so, we have decades of experience in our industry with these models, which ultimately result in outputs or answers on the pricing question. So that's the so-called average annual loss. But they also result in loss probabilities. So what is the 100-year loss, expected 100-year loss for my individual portfolio situation? And these models are, as I said, called the CAT models. And then there's a second suite of models, which is focusing on location-based risks. And I guess you, Christoph, with your experience, you can share with us much more. But the challenge with all of these models is to transform them from data which are based on historical hazards, so historical probabilities of wind speeds or flooding or so, to a forward-looking way of assessing the risk, taking climate change into account. And here, once again, science is the key, and the understanding of science and implementation of science in these models. And that's actually what we do here at Munich Re. So we use the IPCC RCP scenarios, for instance, in these models, which give us a forward-looking answer on different emission pathways and the impact of these emission pathways on the risk. So that's these two different elements or models also which we are currently working on or having already available for our clients.
Right, so mentioned we at Risk Management Partners, we are quite specialized in order to make available this such type of data and analysis. And in the past couple of months, we had really also very intensive exchanges with our customers from the banking sector. Because you have mentioned earlier the location itself, so knowing the exposure, knowing the asset is a key element. Once you have this knowledge, once you have identified your exposure, your liabilities, of course, then you can run such type of analysis. Important part is then first the classification, of course, which hazard might affect this asset or which chronicle risk might change the business model you are invested in. But then in the second, that's now, I would call it the second way, is really to understand this type of concentrations, so to see the financial impact on your balance sheet or the consequences of your business model in this in the corresponding sector. And we have seen, and that's also a very interesting exchange we have, that bringing the expertise from the banking sector together with the reinsurance sector, insurance sector, that really produce a very interesting dialogue in order to understand the exposure on the one hand side, but then also impact on the business on the other hand side. And from our perspective, it's also very interesting, and maybe you can also have a short glance how Munich Re is dealing with. But we see that the strategic involvement and the integration of climate risk in the strategy is of utmost importance, and therefore you need the insights and you need the knowledge about it.
Well, before I get back to my experience in my role, being the chief climate scientist here, and on the technical side, let me ask a question on your experience with this group, it's not entirely new, but with banks and asset managers. As I said in my introduction, my first words, traditionally primary insurers and large corporates have been our main clients. Now we see the demand coming from other members of the financial service industries. So what is the reaction of the banks when they learn about the expertise and the knowledge and the models our industry is offering? Do they already understand, or is there a gap currently there so that they need more advisory, or are they already in a phase where they can say, we can use these models and apply it also to reportings?
Mm-hmm. So I think when you're looking at the motivation, we see three basic motivations. The one is, of course, the risk management. So as you mentioned, identify, measure, and then think about retention or mitigation. The second one is, of course, the topic of reporting requirements on governance. But then the third one is really to understand it. That means we have learned that when banks or financial institutions wanted to deal with the risks, they need the transparency where the KPIs are coming from, what the models are expressing. So if you're asking, is there a need for consultancy? Definitely there is, because there's the need to understand before you are implementing it into risk frameworks, and before you are taking strategic decisions upon it. So this understanding part is really of utmost importance. That's really where we have also very close relationship there with the experts of Munich Re, of course, in order to pass this know-how to our customers.
Yeah, well, that's indeed matching our daily experience of my colleagues and myself. The entire reporting situation and requests coming from regulators results in a lot of question marks in the financial service industry, especially with those who have not been too familiar in the past working on climate change as a potential risk on the balance sheet. And what we learn almost every day is that, especially when it comes to mortgage business, but also real estate investors. So whenever these members of the financial service industries have long-term business on their balance sheet, then the question is now, well, how can we manage them? Also, how can we understand them? And one of the most relevant elements pushing this. Well, also the I shouldn't say perhaps not the concern, because it's already a reality that stress tests are not only in discussion. We have, for instance, with the Bank of England in the UK, we have these stress tests and elsewhere. What is this something where you first of all can say, well, that matches your experience, and can we help already with these stress tests, or at least elements that again, banks, asset managers can move forward on their path to also improve reporting?
No, definitely. I guess that's the daily work we are doing at the moment. We are helping our customers to understand the upcoming regulations, like PRA stress tests you mentioned, or in Australia we see also important changes. So there we are really helping our customers to understand, to learn together with them, and bring the right documentation, the right solutions in order to solve these requirements coming from the financial institutions. And I guess this event over the next couple of days really is a good opportunity to come into an exchange with you as the sector, the banking sector, which are affected by these changes. We all are affected by the constant change of the climate and of the corresponding regulations. So we are more than happy coming into this exchange. So dial in or make the corresponding appointments afterwards. We are more than happy to exchange our experience, and maybe also from Munich Re perspective, maybe some last words from your end, Ernst.
Well, let me wrap this session up with coming back to the core business model and the DNA of the reinsurance industry. And that goes back to what I started with, this understand, measure, manage. And it's probably not too well known, at least that's my personal experience, that there is a lot of cooperation in our industry between the public, the private sector, and science. And science is the foundation. And this is probably one of the key assets which we are having, to have this, not only this first-hand experience as an industry, but having ongoing projects in the forefront of these developments. And by the end of the day, you also can sometimes call our industry sort of as an early alerter. And with respect to climate change, we certainly have been this, and not just an early alerter, we were an early warning system. And now we see, after decades of activity in the science space, but also with regulators and with our clients, we see sort of a hockey stick development and movement just in the course of the last 2-3 years. So the aftermath of the Paris Agreement, the momentum to improve reportings, and prior to reporting, the risk management also with banks has changed substantially, and our industry and Munich Re certainly can be of support to you in this industry to improve your situation, have access to our own knowledge and experience.
Well, thank you very much, Ernst. Well, we are available in order to answer your questions, or to get into exchange with you in order to cooperate on the topic of impact of climate change. Thank you very much.
Thank you, Christoph, and thank you to all of you who have attended this session. Thank you.
Thank you.